Ted, good to speak with you again.
Hi,
Um,
Moeed. Good to see you.
really excited about the company that we're going to talk about today. This business was pretty much the darling story, the fairy tale story during the COVID pandemic. It has been on the lips of almost everyone around the world. So today we're going to talk about Zoom, a platform that we're using currently right now. And if you look at the stock price, my word, that is a story to tell. You know, before the COVID pandemic, it was trading around 118, and it kind of dropped to $109 when the whole market dropped. And in October last year, it reached a high of, I think it was $575 per share. And since then, it has dropped significantly. In fact, now it's trading at, let me see my update, $326 a share. So it's really kind of done that peak, and it seems to start to level out, although a lot of other companies are going through something quite similar because of the whole inflation scare. So really excited to hear your thoughts on the fundamentals and your analysis of this business.
Okay, well, that's a good summary I think you've given us there, Moeed. So thank you very much. So as you're saying, let's jump in and have a look at the financials. So here we have their financial report and accounts audited by KPMG, whoever they are. And let's jump straight down to the revenue statement. So here we see the profit and loss account, or the income statement, and it's really showing their trading. So looking at the top line, as we'd expect, lots of growth in the top line from $151 million in 2018 all the way up to $622 million in 2020. So just to remind ourselves, this is in thousands. There we are. So it's in thousands. So 622 million. Gross profit 507 million. So effectively what we're looking at here is an 81% gross margin. And that kind of makes sense, because if you remember, we looked at Facebook a while ago in exactly the same way. They're just selling access to a platform. So they're not selling a physical product. So you'd expect a really high margin there. Now, what's interesting here is looking at these numbers here. So this is the cost of running the business. And we see sales and marketing in 2020, $341 million. Now, you kind of thought that everybody's heard of Zoom. Why are they advertising it? But they're obviously saying, we're doing well. We've got to keep pushing. You don't kind of, take your foot off the gas. They're going for market domination on the back of their popularity. And interesting enough, how many people are using Zoom? I run training workshops the whole time. I'm often using Zoom. I don't even start by saying, is anybody here not familiar with Zoom? Because everybody's been using it for quizzes, for chats with grandma, so it's a social tool as well as a business tool. And I think that's an important aspect.
Just as a side note there, Ted, because my business is around sales consultancy. So they've hired a lot of salespeople. And there's a significant cost that comes with B2B sales. So there's some trial and error. Sometimes you hire the wrong people. There's development and onboarding of those salespeople. On average, it takes 3 years, we now know, for a salesperson to become fully productive in a new company, even one who might be experienced. So they're obviously investing in salespeople to deliver bigger scale kind of deals with larger businesses. So that doesn't personally surprise me, actually.
Yeah, and there's a bit of an uphill market struggle there. So, they're trying to get into, they're competing against Microsoft Teams, Adobe Connect, WebEx, for example. So a lot of sort of big existing players. And you may remember there were concerns around the security around Zoom. So I'm dealing with lots of clients who actually block access to Zoom on their corporate system. So if I'm running a workshop, people actually have to log on using their own personal laptops and devices rather than the company provided. So there's still a bit of an issue there. Anyway,
Yeah.
the summary comes down to these guys are making a profit 2020, and this is the year ended 31st of January 2020, by the way. So it's just into 2020. So, you know, over a year ago, they're making about $22 million. Now, what we do have from these guys is we have a trading update. So they have produced some forecast figures. So let's just look at those. Here are the forecast figures. And what we see here is we're going to look at this right-hand column here. So this is the 9 months to the end of October 2020, and they compare it with the previous or sort of the equivalent 9 months from the previous year, and we can see here that they're getting down to net income of 411 million.
Wow.
And if we project that out, if we kind of project that forward, then we're expecting the total profit to be about just over $500 million, so $548 million. And interesting enough, that is now a net margin of 23%. So it's a massive change in terms of the net margin. So these figures here that we're looking at, let me just pull up these. So these original figures we're looking at, they're operating at about a 3% margin. So this 22 as a percentage of total sales is about 3%. Whereas if we go to our existing, you know, the latest forecast, and we do the same calculation, this 411 is about 23% of the 1.8 billion. So they're starting now to really generate profit, although we still see lots of, so R&D has gone up significantly, lots of sales, general and administrative, and there's a reasonable amount of the so sales and marketing is increasing, and a reasonable amount of sales and admin, and that's quite a big number there as well. So they're starting, you know, they are starting to deliver the goods. The problem these guys have got is we're coming out of lockdown. The vaccines are all going out. I've had mine. We're kind of just going, you know, it's time to get back into work. And you listen to a lot of the kind of the comments. Jamie Dimon, CEO of my old boss at JP Morgan, you know, saying that really we got to get people back in, you know, how are we going to learn from each other? You know, how do we create the corporate culture when people are at home? He's really, JP Morgan is saying, you know what, guys, you know, there's a little bit of working from home, but actually we're social animals. We're going to be back in the office. And this is the challenge that Zoom, I think has, and this partly reflects the challenge in their share price. So there's the P&L account. So it's just to kind of, you know, they just got high overheads. They've got this big sales and marketing. You know, they're obviously, you know, riding the wave, and they're going for world domination. Good luck to them. Let's look at the balance sheet. So here is the balance sheet, top half of the balance sheet. Again, lots of cash. You'll notice, again, they've got lots of these marketable securities. If you remember, this is just where you park cash. So it's effectively, basically, it's bonds. But we can just think about marketable securities as another word for cash. So they've got a lot of cash. The cash has grown from the money they raised through their flotation. Now, one interesting aspect about these guys is this number down here. So if you look down here, we've got some deferred revenue and some more deferred revenue here. Now, this deferred revenue, this is, we've discussed this with similar companies in the past. So deferred revenue is money I've received but not yet earned. So I have a subscription with Zoom. I'm paying on a monthly basis, and I get an offer from them that says, why don't you take out a yearly subscription and we'll reduce the price by, I don't know, 20%, something like that. So what they're trying to do is to get me onto a yearly subscription from a monthly subscription. And that means that if I buy the year today, I'm giving them lots of money, but they're not actually going to earn that money until next year when they actually deliver the Zoom service. Okay, so from an accounting perspective, it has to appear that money that I give them today that relates to next year has to sit in the balance sheet as deferred income, or income I've received but not yet earned. I must defer it until next year. Okay, so that's kind of where we're seeing this deferred revenue. Now, what's really interesting about these guys is this number up here. And this number up here and this number here, this is about 90 million. Okay, now these are deferred acquisition costs, deferred contract acquisition costs. And I think that these are the costs associated with generating this business here. So the theory is that if you pay a salesperson today to go and generate a contract, and the contract, you earn the contract next year, you can take the cost of the salesperson and also recognize that cost next year. Now, this is a concept we come across in the insurance world. This is very, very big in the insurance world. It's called deferred acquisition costs, and it's a kind of a standard way of accounting. It's all about matching our costs and our costs and our income. I've never seen it outside of the insurance world. Doesn't say it doesn't exist, but I've never seen it. So there's a real question mark. I understand the deferred revenue, but deferring your costs is a kind of, it just makes me a little bit nervous. Now, we can compare the two numbers. You've got 230 million of potential revenue next year and 90 million of costs. That's still a profitable piece of business, but it's just the fact that they're deferred. Traditionally we kind of, we incur the costs today and recognize that we're going to be generating revenue next year. So to me, that's a red light. That's a kind of, you just need to be aware that this is going on in this company.
Why does that, just out of interest, why does that make you nervous?
Because you shouldn't really, if you think about it, you made a comment about how it takes 3 years to get a salesperson up to speed. So when we see the sales and marketing and that enormous cost in the profit and loss account, a little bit like research and development, we recognize that's not the sales, that's not the cost of generating the sales this year, but there's also a lot of kind of investment in the future. Whereas here, what they're actually doing, they're taking some of those costs out of the profit and loss account and parking them in the balance sheet. And that just means to me that they're pushing their revenue, that they're basically inflating their profits. So if they hadn't done this, if that 96 million, if that 91 million, if that 91 million was actually recognized as a cost in 2020, then they wouldn't have made a profit of 21 million. They'd have made a loss of about 70 million. Okay, so there's a little potential for window dressing going on here. So I'm not saying, it's obviously been checked by the accountants. They're allowed to do it. They're complying with the laws, but it kind of just looks a little bit funny to me. It looks like there's a little bit of kind of window dressing going on.
That's interesting.
And it makes me a little bit uncomfortable. So that's kind of, something to kind of just be aware of there. Looking at the balance sheet, whiz down to the balance sheet. Sorry, that is the balance sheet. The other part of the balance sheet is we see again, they've got this this convertible preference stock. Now we've come across this before. It's a favored method of companies raising finance pre-float, and it's neither debt nor equity. It's somewhere in the middle. So here's the non-current liabilities up here. So that's effectively where you would park your debt, and down here is the equity. So that's where you put your equity. So you can see they kind of presented it as somewhere in the middle. Personally, when I do my analysis, I park it in here. But you'll notice that actually it's then being absorbed into this number down here. So effectively on flotation, these preferential stockholders, they exercise their stock options, they turn them into stock, and they can either hold that stock in the company or they can sell it and realize their investment. So in effect, what we're saying is that they've got a negative balance sheet the previous year. The balance sheet's gone positive, and the reason the balance sheet gone positive is that they floated and they raised lots and lots of money through that flotation. And we can see that also in the cash flow. So here is the cash flow statement. And we see in the cash flow, down the bottom of the cash flow, here's the money that they're raising from the IPO from the flotation, and they've had to separate out some which they've got to pay to the tax man. And then we also see here these two numbers here. This is kind of when we look at the cash flow, we really need to remove those numbers, because this section is about investing in the cash flow from investing, which is buying tables and chairs and plant and machinery. And they've got this purchases of marketable securities and sales of marketable maturities of marketable securities. And this is really just, this is all about just cash. So it's a bit like putting your cash in a deposit account and calling that an investing activity. That's not investing, that's parking. So if we are going to do our analysis on this company, we really need to be kind of removing those numbers that I've highlighted, these numbers up here, so that we're not being distracted by them. And what we see is a company which effectively is, there's a little bit of investing going on, without that, but they, basically their cash balance is increasing, and their cash balance is really increasing because they're generating lots and lots of lots of cash from the sale of the shares from the IPO.
Right.
So it's, how's the company performing? So we talked about the marketable securities. They've got lots of cash. We talked about the deferred acquisition costs matching to the deferred revenue. It's generating cash, which is great. But again, part of this cash generated here, lots of that cash generation will be money I'm receiving today that relates to revenue that I'm going to earn in the future. So there's this number up here, which is effectively saying this is the cash they've received in this year that relates to the next year's effectively.
That's a lot. So that's a large amount.
Well, it is a large amount, but it's on sales of remember that this is on sales of what, 622 million. So that's part of their business model. I think that doesn't appear unreasonable. And we're going to see further strong cash flow if they can hit their forecast sales of 2.4 billion, for example. So at the end of the day, they're not burning cash. It's this number down here, this 499 is effectively a misnomer. It's a distraction. That number should actually read about 43 million, which is effectively these numbers here added together. So it's not 500 million they're investing, it's 43 million, which kind of makes sense because there's a bit of software upgrading and computers, but they don't really need that much more in terms of the investment. This is just effectively their cash, which is parked waiting to be used. So they're not going to run out of cash in the near future. They're not burning cash. They're making a profit. I'm expecting to see their profit come down a little bit, so they're not going to be making lots and lots of profit in the future. So if we go back to their share performance, which you were alluding to beforehand, we can see their PE ratio is, well, they've put 145 there. Well, if you take their 2020 results of 20 million and you take a P ratio on that, then it's 4,500 or 4,400 times, which is, even Tesla would be jealous of that kind of P ratio. So 95 billion on a profit of 21 million. That's quite an expensive one. They've got 145 P ratio. And remember, P ratio is the price to earnings. So it's how many times you're paying the multiple of earnings. So the best way to think about that P ratio is if you buy a share today, how long until you get your money back? How many years profits do they have to carry on, statically just churning out those profits to give you your money back? And we're saying 145 years today, and that's after the stock has come off the boil. On my projected, so I did my little projection based on their forecast results, and even on my projection of $548 million of profit, it's still 175 times earnings. So you might buy 175 times earnings if you've got a company which is growing and it's growing rapidly. Remember, Tesla is only making $721 million in profit and is expected to become more and more profitable as it kind of, goes to its world domination. These guys, where's the market going to go? Is it going to become the de facto way that we communicate? Zoom's going to be around for a long time, forever. It's going to be around for a long time. It's part of our lives, and I haven't got a problem with that. But they are competing against, in the corporate world, Microsoft Teams, WebEx, Adobe Connect, some really established players who've got very, very good, secure platforms. There's lots we like about Zoom. It's a lot easier. It's nice and simple and quite intuitive. But I'm kind of feeling that if we come out of lockdown, people are going back to the office. There's going to be less people subscribing to Zoom, less of the kind of the local councils who need to run. I mean, like my local church, for example, they subscribe to it because they need to run a service for an hour, for example. So they need to be on the subscription. But as soon as we're back in as soon as the lockdown's lifted, that subscription will be cancelled. So they're going to see attrition as a result of losing lockdown. And I think what they're trying to do is to invest to get into the corporate world, because that's where the stickability, sustainability is. I don't think you're going to see a lot of money coming through from the retail market, if that makes sense.
Yeah, well, there are a lot of opinions and emotions when it comes to Zoom. So be interested to hear what everyone else thinks about this. So what are your thoughts on Zoom? Be interesting to see how they develop. And I think it's called their Zoom. I think it's called Marketplace, but I may be wrong. But they're developing a lot of apps. They're developing some new ways and new product lines. So it'd be interesting to see how that works out for them. So what are your thoughts? Like, share, subscribe to our channels, but definitely share these videos amongst your friends and colleagues and your communities. What do they all think? And what do you think? Let us know. And by the way, if you want us to, if you're thinking about investing in a company, or if you're thinking about doing business with a particular company, or even if you are about to have an interview with a company, a job interview, if you want us to analyze a company for you, leave a comment in the comment sections below, and we'll create a video just for you so that you can make smarter decisions and smarter presentations. So Ted, thank you. This was really interesting. You did not disappoint, and we'll see you on the next video.
Good to speak to you, Moeed. See you later.